You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, the mothership, the flagship, if you will, upon which the stream upon which all of these things flow and which all of our content is located. If you haven't checked it out in a while, listeners, I encourage you to surf over there and do just that. And also from the Options Insider Radio Network, upon which all of you are listening to this fine program right now. I always say ever expanding, and it is indeed expanding as we speak. As you're listening to this, listeners, we're adding the latest addition to said network, the Options Oddities program, a daily program that I do with my nemesis over there, Andrew Giovinazzi. We do it every day in the TD Ameritrade chat room, so if you're interested in some unusual options activity, what's cooking in the old options markets, that's a great show for you. Check it out. You'll be able to find it wherever you find this fine Volatility Views program. And joining me on said program on the old Volatility Views panel are my two volatility partners in crime, starting off with the man who was formerly all over the East Coast, but has now settled down into scenic and lovely Westchester, New York. Mr. Jared Woodard of BGC Partners. Jared, welcome back to the program, sir, and congrats on finally finding a home. You're a hermit crab no longer, sir.
Thanks a lot, Mark. I'm really glad to be with you, especially now in this cooling off period at the end of summer, and glad to have a chance to talk markets in a less tumultuous set of circumstances.
Yes, that's one way to view it. Less tumultuous. I like it. The glass is always half full in the Woodard house. I like it.
That's right.
All right. And also joining us from a little bit farther up the coast, you know him, you love him as the Rock Lobster. He is Mr. Andrew Giovinazzi from OptionPit.com, all the way from the great state of Maine, taking a break from his lobster feast and fishing, listeners, to join us here on the old program. Mr. G, welcome back to the show, sir.
It's a pleasure to be here. You must like me on the show, or somebody do, because I feel like I do 2 or 3 shows a week with you somehow.
At the very least.
At the very least.
Hey, I guess the listeners must demand it. I don't know. I'm just a slave to their whims, sir.
I guess. You know what? That's what I get. I got an Option Insider Radio Network shirt, and I've been doing the shows.
That's
ever
it.
since.
Once you get the shirt, you're locked. I don't know if that was part of the.
In.
There was a little agreement in that shirt. You may not have noticed it when you opened it. That says you are now forever locked to the network. All right, with the team assembled and a less tumultuous week from a volatility perspective in the rearview mirror, let's dive right on into the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, right, listeners, you know what time it is. It's time for the Volatility Review. This is, of course, the portion of the show where we look back on the week that was and in many ways still is from a volatility perspective. We are recording this, listeners, on Friday, August 29th, right in the middle of the session, right around noon Central. And as we're recording this right now, most of the major indices up fractionally on the day, but no real big developments there. Volatility also ticking up a wee bit, which is interesting in and of itself, given that it's a general up day in the market, and also the fact that we're heading into a long holiday weekend. Of course, the Labor Day weekend here in the States, which is typically usually just ringing the dinner bell for market makers to just crush all options, crush all the vol, take all the theta out way before the weekend starts. And yet here we are on the Friday morning before a holiday weekend, and so far at least, they appear a wee bit reluctant to do just that. The VIX Cash up a little bit on the day, about a little over 1% on the day to 12.2 right now. So interesting stuff. It's been an interesting week. The VIX Cash had, like Jared said, a less tumultuous week, a bit of a range, but nothing too out of ordinary. About 1.5 points, about 11.25, up to about 12.73 or so in that range. So not a heck of a lot of tumult in the market. Not surprising going into a long holiday weekend. People like to typically keep their powder dry going into events like this. So it wasn't the crazy breakneck pace type of week that we've seen on recent shows, but that Jared said that's actually kind of good because it gives us some time to pause and reflect on what we've been seeing out here in the market. So Jared, we'll start with you. What was your volatility week in review? What caught your eye amongst all the myriad products that you watch, and what trends did you see developing in the marketplace this week?
Well, there's some interesting things happening in individual stocks, as we've been noting kind of all year, the rise of individual equity options as a place where the stories really are. But at the broader level, at the index level, I think there's an interesting story going on in energy, which I think we'll talk about a little bit later in the show. And then in just the big equity indexes, as you kind of already alluded to, it's not the biggest deal in the world, but when you see weeks like this where the price indexes are all higher, stocks are moving higher, but implied vol is also getting bid, that's something notable because you can look at it on a contrarian basis and say that rising stocks and rising implied vol means that maybe people are paying up for protection perhaps early or without some obvious catalyst. But historically, it's also a situation that can mean less positive returns than normal over the short term. And while the statistics can change on that over time, I think that when you do see a bid for protection, even though everything in the market is pretty calm, that does deserve some notice and as a potential warning for the short term. And that's certainly what we saw this week.
Jerry, we were discussing on another recent program on the network, and maybe you're aware of something that I'm not here. Are there any studies you can think of that analyze performance in this type of scenario? Maybe not the holiday weekend, but typical weekend, they crush implied vol, perhaps overdo it to a degree, and then implied maybe gets a little bit of a bid on the following Monday on the opening bell there. Have you seen any studies on, let's say, someone took the other side of those trades and essentially bought premium over the weekends and then sold it out again on Monday morning? If how they would have fared, essentially getting perhaps a free weekend worth of premium or gamma for little to no cost.
That rings a bell. I'm trying to think of where that would have come from. Yeah, it's not coming to me right now, but I know that someone has looked at this. I think that it's that's kind of one of those strategies that is the kind of thing you might do in chunks, maybe in this quarter, but not last quarter, depending on what you can observe in the market going on. Because I think some seasonal trends and what else is happening in the marketplace really plays into that, meaning, if the market's overall calm and everything's looking good, then those weekend effects and these kind of the kind of potential edge that you're referring to is probably going to be more dominant than in a situation where there's some kind of big story driving the market down or up. And so I think this is probably a good scenario if you were going to trade something like that. But I'm still can't think of where that study would have been. And this is certainly also one of those things that people look at when they notice on a given Monday morning, the VIX index might be notably higher. And if you're not paying attention to those weekend effects and to the way the index is calculated, that it can cause a jump to conclusions about what's happening in the VIX, when in effect we know that it's just an effect of these weekend phenomena that you're talking about.
Well, it sounds like we have another $5 study coming your way. So that means I'm into you for $10 now. $5 for the quarterly straddle study, and now $5 for the weekend effect study. I'll be expecting those on my desks, my desk next week. And do you accept PayPal? Will that work?
I'm really feeling the pressure now. I got to get to work.
All right.
You can almost buy a cup of coffee.
I know, almost in Chicago here. Of course, I'll let you get to work now, Jared. I'll let you collect your thoughts for a minute on those studies while I turn it over here to our other crazy cohort here on the show. Andrew, you and I, we're both market makers. You and I both know, as a market maker, you pretty much never miss an opportunity to dump premium. Sometimes going into these types of long holiday weekends, the premium sale, the fire sale, if you will, would start on Wednesday night and definitely into Thursday. Certainly by Thursday afternoon, you're feeling some pressure on those bids. Not see anything coming out by, here we are, mid-session on Friday going into a long holiday weekend. That's unusual. That probably lets you know that A, things are thin, B, there's something else afoot in the rest of the world that makes people perhaps a little bit reticent to blast away on those bids.
Yeah, I would say the problem is Novo Rossiya or something like that. Rossiya, whatever Putin is trying to accomplish in the Ukraine. We were actually talking to some of our pro traders today about this subject, and anyway, it's just the Russian for Novo. I'm not pronouncing it right, obviously, because my Russian's not very good. But it looks like Putin wants a big chunk of Russia. Like there's a kind of an old thing of big piece of Ukraine that the Russians, I guess, historically have wanted, and they seem to have their rebel guys are in and amongst this old area of sort of southeastern Ukraine. So it seems like he wants it. That's what his end game is. Anyway, it's unsettling the world because the VIX right now should be about 10. Realized vol is super low. There's been I would say, if we can talk about this later, but almost no future premium decay. It's been crazy. They just do not want to let a near-term future below 13. Nobody wants to sell them. So I think this little Tolstoy-esquian dance. No, that's actually a word that they're playing in the Ukraine is the thing that's keeping volatility up. Because most of the economic data has been decent. So when I don't see that, the next thing is kind of geopolitical risk, and that's what we got. So I think that's why vol is not doing anything.
The Tolstoy-esquian dance, I like that. That might be a new technical term here we've just coined on the show. But that's the best part about that part of the world is if you go back far enough in history, everyone has a claim to everyone else's land at some point. Yes. Everyone's invaded everyone else. Everyone else has killed each other's grandfather or something along those lines. So there's claims for vengeance and land and everything else. You don't need to look that far back to justify whatever the heck you want to do. So it makes it nice if you're a guy like Putin. Yeah, exactly. A lot of umbrage. High umbrage quotient out there in that neck of the woods. But you mentioned the futures, and that's kind of interesting too, because we were talking on recent shows about some of that backwardation creeping into the nearer part of the futures term structure. You're saying you're still seeing that, or at least it hasn't mitigated much since the last time we talked.
You know what? They're not backward as much anymore. Is that there's just an awful lot of so the September future is about $1.40 over the cash, and you only have 12 trading days left.
That's pretty rich.
It feels a little rich. You also have realized vol 5%. Now, normally, I think there's some statistic about, 5% realized vol in the SPX does not stay around very long. Usually you get like a 1.5%, 2% move, something like that, once realized vol gets super low, because we have really light volume right now. So I guess everybody's waiting for a move. So the vol's going to stay up, or all the vol products are going to stay bid until they get their move. And then it will be fairly priced. And that's how volatility, that's how the vol products work, is they're real funky insurance products. And they try to do their best to insure about things that might happen in just the near future. Whether they're right or not, or wrong or not, what that the market plays out. But that's essentially what they do. And the signal is for higher vol in the not too distant future. That's what the signal from all the vol traders are. And the only place I can see it really coming out of is is either a bad or a good resolution to this Ukraine thing. Because what else is on the radar?
I think Putin's just long some downside in the SPX and long some verticals in VIX, and he's just talking up his position all day. That's all he's doing over there.
Well, that way he can buy a new house. Just think of it. You go buy some puts, and then you go invade.
There you go.
You make money.
It works.
And then you buy another house.
Yeah, this sounds like we're halfway to the plot of a James Bond movie.
Yeah, we are. It's funny you mentioned that, Andrew. I had someone bring up to me this week, and I haven't heard about him in a while. Someone bring up to me in a question on one of our shows about the old Bin Laden puts. You remember those? And there was all that tumult coming out of 9/11 that they thought it was Bin Laden or his cronies were sophisticated enough to buy a ton of downside in the SPX. Then I believe if you parse that trade, it turned out to be a box. So it was the most innocuous thing it could possibly be. But it looked on the surface, all they saw were some deep puts going, and they said, hey, this is crazy business. So yeah, maybe, who knows, maybe Putin's working some out of the money. Some Putin puts. That'd be the new term, the Putin puts.
The Putin puts? Well, I try to write a blog. I think Putin is trying to put the put back in. He's trying to put the put back in Putin or something.
Easy for you to say. See, certain things work better in blog titles than they do in radio. And myriad P's in a row, probably one of them.
Right now, I'm gonna just concur.
Talking about the VIX, let's dive into what we're seeing out there in the old options. Like we said, hasn't been the heaviest of volume days of late, but VIX, even a light day for the VIX is still orders of magnitude more than any other product would trade. They're doing about 573,000 contracts a day these days, so fairly robust. A little light today. Looks like about 140,000 going up so far today, but still some time left in the session. You'd think going into holiday weekend there might be a little bit more going on than just that, but like we said, people are not crushing the vol either, so all kinds of weird things are afoot these days from a volatility perspective. Looking at where people are playing out there, like we talked about before, calls versus puts. Calls always the leader when it comes to VIX. Of late, that had mitigated somewhat because the VIX had rallied a little bit. VIX has since come off some of those highs. I call them highs loosely, near-term highs, I suppose you can call them. But maybe as a result of that, or also to some of the interest out there, we're seeing the VIX getting very call-heavy again, perhaps even beyond what we saw before. Right now, it's hovering right around the 4.2 call-to-put ratio in the open interest, which is just astronomically high, even for the VIX. It's ridiculously high. Looking at where people are playing out here in VIX land these days, pretty much all SEP until you get a little bit down the chart, then some of the longer term stuff kicks in. Topping off the charts today or for this week really, are the Sep-19s. Again, pretty much all call except for one put on the list, listeners. Almost 300,000 open, about 288,000 open on the Sep-19s. Almost the exact same number open on the Sep-20s, so some parity there. 270,000 open the Sep-16s. Interesting about that strike, that's also the biggest gainer of the week here, about 27,000 contracts in open interest here. So the winner of the week, at least from a open interest perspective. And then the Sep-17s, 257,000. OC-16s, here we get a little bit longer term. OC-16s, 242,000 contracts open. And then out to the Jan 20s for 213,000 contracts. So people playing a little bit of optimism out in Jan these days. And then the Sep-21s, Sep-15s, Sep-28s, all rounding out the bottom there, 212,000, 191, 189. And then bringing up the rear, we get the first put action of the list here, the Sep-13 puts. So some pretty much in the money at this point puts 161,000 contracts and change up on that strike. So interesting to see one put strike at least making the list, which is interesting in and of itself. Moving on out to VIX's little brother there, the VXST. We've talked in the past about how this product perhaps not really catching on despite having some opportunities for some decent volume in recent weeks. This week, not so much, not the tumultuous week we've had in recent weeks, as Jared alluded to at the top of the show. So if it hasn't caught on in the tumultuous weeks, probably not going to catch fire in the lighter weeks, and that's certainly what we saw this week. As we're looking at it today, like we said, about halfway through the session or so, and only 200 contracts having gone up so far today. So not the most robust day. It's only averaging about 800 contracts and change. That's substantially off where it was even a few weeks ago. So the numbers coming off here in VXXT, only about a hair shy of 2,000 contracts open on the entire product. So this product, for whatever reason, it's not catching fire, even in some scenarios where you think this product is ideally suited for use case. Right now, VXST hovering at a little bit of a discount to its big brother, about 10.66, up about 3% today. So a little bit more of a pop going on, even in the nearer term VIX products. And then leading the charge here, all of these positions, essentially, except for the bottom one, which we won't even get to because it's only 5 contracts, are expiring next week. The biggest open interest position out there are the VXST 18 calls expiring next week. About 1,000 of those open. And like I said, only about 2,000 contracts open interest so far. So the next biggest strike are the 14 halves going out next week, 661 and change. Then it pretty much drops off precipitously from there, 100 contracts open and down the list. Again, not many puts to speak of there either. We say VIX is call heavy. VXST is overwhelmingly call heavy. It's just on another level when it comes to call volume and call heaviness, shall we say. Jared, not really much of a surprise here that VXST not lighting it up this week, but a bit of a surprise that in the previous weeks it didn't really catch fire either. Anything really catch your eye out here in VXST? Or are you still playing the wait and see like everybody else with this product?
Well, I mean, the thing to notice is the lack of news, and in this case, no news isn't necessarily good news for the product. But I would have thought that August would have been a really great case. You had a big pop in implied vol all around the world, not just in the U.S. But I guess traders just weren't expecting anything to really last, and so that might be why they weren't going to play in the product. Maybe when you get a higher volatility regime overall, where you have more spikes up and down within a range, that's the scenario where I guess we might see more volume and sort of sticky open interest in the product.
Andrew, you said before that you're kind of watching and waiting in VXST. What would it take for you to pull the trigger out there? Is it just a little bit more liquidity to tighten those markets up a little bit? The VXST has been moving, so it's not the underlying movement that it's lacking. Is it really just the paper you're waiting for?
Paper and just kind of really an opportunity to be honest, it's like the short-term vol product. Okay, I think vol's going to jump. Where are the short-term futures? Does it look reasonable? Because you need the futures to move well with the underlying as well. So for me, it's like if I think vol is going to pop, it's going to be fast. I'll get more bang for the buck there. And to me, it's just such a pure spec product. And I just haven't had any real, angst or reason to go, basically to buy vol lately. That hasn't already been bid up by the time I think about it. So it's just there hasn't been a really great entry for me at this point.
You mentioned the VXST futures, not something we've really talked about here on this show. I can't remember the last time I've actually even checked in on the VXST futures. They're not really doing a heck of a lot of volume, but I'd imagine the term structure out there must be backward to all hell unless it's something else weird going on out there. Have you had a chance to check in on those futures of late, Andrew?
I would love to say recently, but mostly I just look at them at the money for where they are at the particular time. So right now, it's the, let's say the SEP for next week, the future is straight. Yeah, they are. I mean, the SEP 11 future, what is that, 50? It's trading like 1150. So, I mean, the future premium is still plenty expensive relative, and then if you don't get that shock move in the cash, the options are barely going to move. So right now there's already 70 cents built into it. So the whole idea is if you buy an option there, you want to make sure that the underlying is going to move enough for you to make some money on it. So, and at the level they are right now, it's just not, it's not worth it for me. And I don't think we're going to have a jump in vol unless, like I said, unless whatever the Ukraine, I can't even imagine if the Ukraine situation gets worse, nothing really happens anyway. Right. So, it's just I just feel it's like suspended animation. And right now, a product with that much premium in its short term, I just don't see how I just don't see it's something you want to buy at this point. Short.
If VIX is languishing and VXST are languishing, most of the other volatility index products are going to languish as well, including the RVX. Not a heck of a lot going out in Russell land these days, even though we're starting to profile more interesting premium type trades in a lot of small cap names on things like our options oddities program and other unusual activity programs on the website. So perhaps there's some general movement afoot out there for a little bit more premium to start trickling in to indexes like the Russell as these small caps start to catch a little bit of life. But right now, VX Options, not surprisingly, the top chart here coming in the SEP calls, the SEP 30s to be precise, about 200 or so open there. A fairly aggressive bid that's been up there for a while. And then the open interest pretty much drops off from there. Mostly calls, like we said. All these vol products and RVX certainly no different. Very, very call heavy. Not a lot to change there. So, all right, that's going to do it for our volatility product, our volatility index rundown. And now we're going to dive into some of the other asset classes that, surprise, surprise, also exhibit volatility. Yes, listeners, there is volatility in things that don't have VIX in them. So let's look at the shiny stuff first. This is the metals. Some interesting stuff cooking out there. Perhaps, Jared, we'll start with you. What really caught your eye out here in metals land this week from a vol perspective?
In metals, there was a big pop in gold implied vol, for example, in late July. That's really worked off through most of August, and now at around 12.3 or so at a 3-month horizon, implied vol in gold is back to where it was for most of June and early July. Realized vol is coming off as well. So you're just seeing a gradual trend lower overall, consistent with what we've seen in the last several weeks. There's not a lot of expectation, I don't think, in terms of monetary policy or demand in emerging markets that would give any justification for an uptick in gold vol right now. And I think that's why you're seeing implied volatility come off a bit.
Yeah, you're right. That's pretty much been the narrative out there. We saw that spike post Middle East and Ukrainian crisis, really the onset of those. We saw that spike in vol in those products, and then ever since then, those levels have pretty much proven to be unsustainable out there, and the vol has been trickling off pretty much ever since. We've seen a few periods where they caught a little bit of a tailwind, and last week it caught a little bit of a tailwind, but it pretty much has leveled out since then, and not really a heck of a lot in terms of vol being exhibited out there as we speak. Looking at the big ETF, a lot of you guys like to trade out there, of course, GLD, the vol out there, which is a GVZ, which we've had our infamous debate on the show whether the futures actually existed or not. That's off about a point this week, and the vol right now out here in GLD and in some little bit longer term months like October, hovering around 11.5, and that's pretty much in line with what we're seeing on the big futures as well. The OC options on the futures trading right about 11.5 vol, and the DEES options on the big gold futures trading a little bit of a premium, about 12.15. But again, not record levels in any of these metals products right now. People still playing the wait and see game. Mr. Andrew, anything cooking over there at the pit from a GLD or an SLV or perhaps even, dare I say it, palladium perspective? I know you're big on palladium.
Actually, all the metals are resident gold bugs. They're all kind of they're in hibernation because look at gold. It has done nothing. The vol is in the toilet everywhere, essentially in the metals, I guess, at least for gold and silver. So it's just not a lot. There's just not a lot there. There ain't no there. I don't, essentially if there's something without any volatility in it, and I know it sounds crazy, but I do like to sell, I do like to sell juice to pay for my long juice. So, and there just isn't much. So whatever the inflation expectation that we used to have seems to have been stamped out of the metals in a pretty big way, as far as I can tell anyway.
Yeah, I'm looking here as we're talking, actually, just happened to be parsing the GLD options chain. Looks like the biggest trade of the day actually is 1,000 lot of the OC 134s going up today. I can't tell if it's closing or not. It's about 2,500 open on that strike. So it could potentially be closing, could be an override out here, or it could be perhaps a flurry, a spate of optimism flowing into GLD. The gold bugs are back, perhaps, and picking up some upside. We'll have to parse that one a little bit more to see. But the rest of the chain, fairly light. Certainly no other blocks or strikes exhibiting that much volume today. Only about 43,000 contracts going up today. So maybe some of the front month weeklies, but that's really about it. Interesting stuff. And, Jared, you mentioned kind of the trajectory of gold vol. Energy has been exhibiting a somewhat similar trajectory. We saw a spike in oil, crude oil vol, and all the other energy products really right around the time of the ISIS crisis over there in the Middle East. And then it since has dropped off as well. on the heels of reports coming out of that region that, hey, surprise, surprise, we can still produce oil even though bombs are dropping and insurgents are taking over cities. Oil production still pretty much keeping a pace over there, and so that pretty much has weighed on not only the underlying but also the vol out there. And we've seen pretty much it coming off as a result over there as well. Anything else catch your eye out there in the land of crude vol, or perhaps any other energy product out there while you're keeping an eye on those things, Jared?
Well, that implied vol, that bid in premium for crude filtered through to equities that are sensitive to energy, and you saw this in individual equity options and also in the sector ETF XLE, a bid in August for implied vols in all those names, and that has come off so sharply, in fact, that while there's still a bit of a bid in crude, around 15% or so in some strikes, the options on the sector ETF on XLE are back down to where they were in July. So they've completely worked off that premium and look much more attractive than they did several weeks ago. There's some interesting talk about valuations in some of these energy firms. As you mentioned, the supply domestically really provided a lot of a buffer against concerns about supply shocks elsewhere around the world. And so I think that in the minds of some investors anyway, that makes these energy stocks have a little bit more of a moat, a little bit more attractive on a fundamental basis than they have been in past years. And so it may be that for the next several years at least, selling premium when the implied vol spikes in the way that we saw earlier in August might remain a pretty attractive strategy. With that said, implied vol in crude has been a little bit more reactive, a little bit more responsive, even with the decline in options from the peak of August. The bid hasn't completely come out there, and realized vol in crude is up considerably where it was, in July still as well.
Yeah, that's the interesting part. I'm looking at this chart of realized vol out here in WTI as we're talking, and you're right, it had a nice blip from a realized vol perspective just in the past week. So we're seeing a little bit of vol being exhibited there now. At the same time, implied, as we've said, has kind of trailed off. So we're starting to see that point now where realized and implied are starting to intersect. If you compare multiple products, like let's say the WTI in October versus the ICE heating oil in October, those products are actually starting to intersect, which may indeed reveal some interesting buying opportunities and some spread opportunities out there. Certainly not the premium selling opportunity it was maybe a few months ago out there in crude, where the implied spiked and has since has trailed off. Maybe it is time to, dare I say it, and I hope Don S. isn't listening, but perhaps even buy some premium. Andrew, I know you're a diehard premium buyer, but you like to get your juice for free. Has anything out here in the energy sector really caught your eye? I mean, I know you love your USO. Have you been gobbling up some USO?
That was actually a decent trade for a while, just because the vol was hugely underpriced, I thought. As far as, more energy, actually I've been more looking at the energy stocks like utilities, and things look like they're heating up in there a little bit. Nothing yet to be a trigger pull as far as that goes. But like you said, seems like we're awash in oil, and not much is making those products move anymore. So it's really it's funny when the vol gets so low. Sometimes realize vol in so many things at once. He's like, I just can't believe it's going to stay here forever.
Yeah, it really is a market where you have to pick your poison and pick your moments when you're a premium seller, because it's getting those opportunities are getting fewer and farther between. Again, I hate to keep plugging our shows, Andrew, but as we've seen in our Options Oddities and other programs, people are going farther and farther afield to find premium and places to do it. And when they can find it, they're jamming 10,000 contracts at a clip through those holes to snatch up as much yield as they can. Because
they certainly are.
And so many products across the board, whether it's index vol, whether it's commodity vol, wherever you're looking, it's starting to become buy-in season out here. I'm looking at these implied vol levels versus realized vol levels in the energies. It makes me want to start buying as we're talking here. Andrew, when you're talking about buying juice, and I always give you a hard time about that, I know you look at a lot of the ETF products. Do you ever pull the trigger in some of the larger, the WTIs and products like that, and the options on those, or is that more of a fewer and farther between type trade for you?
So, okay, what do you mean by WTI? Like the
big crude oil futures and options, as opposed to the ETFs like USO.
I don't really trade future options, mostly because I don't like the data. I can't get very reliable volatility data.
Yeah,
on
you're not
future
alone. We have a listener writing in about that a little bit later.
It's just, I would love, as a business, I think that would be a great business to go and actually start to collect volatility data on future options and futures. I don't know why it's not really out there and commercially available yet, but I think there is a business there. But yeah, that's the problem, is I just, without really reliable vol data and stuff, I don't tend to look at it too much. And that's, I guess, unfortunately, that's not great for the radio show for an answer, but that's why that's why I don't play. If I don't have any good indicators like in front of me, it makes it difficult to do the stuff that I like to do.
Yeah, you're not alone. Certainly, that's a problem for a lot of people who are expanding their horizons a bit beyond the traditional equities and index options and want to look a little bit farther afield. The good sources of data on those products, the farther afield you go, the data just kind of falls off a cliff. And so having reliable sources of information to make your trading decisions becomes much more difficult. But of course, we have a man on the show who has reams of data at his disposal, including looking beyond these here borders. We're not provincial on this show. We look at international vol as well. Mr. Jared, what has caught your eye out there, in particular, perhaps, let's say, in the Tigers region, and perhaps even in South America? We'll go that far afield on this episode.
Okay, well, I was looking at some of the implied vol charts for some of the countries in Asia and for Brazil, yes. And they all kind of have displayed the same pattern over the last several months. New lows in June and early July, the big spike in late July and August. But I think that what's notable is the divergences. So you've had both Japan and, for example, emerging markets that, things based on the EEM ETF, both pushing back towards their July lows. But at the same time, we see Brazil has retained its bid all through June and July and August as well. And I think there's a lot of idiosyncratic risk in Brazil that people are paying attention to. They've struggled to generate solid growth for a while, and recent GDP data kind of confirmed that struggle continues. They're caught between low growth and pressures from inflation, and there's an election coming up in October that I think a lot of analysts expect could mean some big changes. So most likely for those reasons, you've seen implied vol using the VIX methodology for Brazil in around the 25% region for 1 month options. Most of the summer, it's up to about 26 and change now. So that's a big divergence versus the rest of the world. Another thing that I would note is that the Japan story, I think a lot of investors are familiar with, that Abenomics got a big reception initially, and markets really rallied, but have kind of stagnated, and the data in Japan has been very mixed over the last quarter or so. And just some really legitimate doubts, I think, at this point about whether the project is going to succeed or whether they're going to start to lose traction and fall into something much more ominous. But you would never know that from looking at least shorter term options priced on the Nikkei or other indexes in Japan. Those are priced right along with where you would expect comparable levels to be for other developed markets. So it may be that there's an opportunity there with some further study for potentially a long volatility position in Japan, especially if you have serious doubts or skepticism about the economic plan.
Now, we know we got the Nikkei and other products over there to play some of those Asian names. But if someone wants to come in and maybe try to play some vol in Brazil, there's a myriad of BRICS products. Those have all sorts of other things baked into them. Is there one go-to product you have for when you're tracking and also trying to trade implied out there in Brazil that you could recommend to some listeners who want to maybe dip their toe in those waters?
Yeah, I mean, there's the EWZ ETF. Has very liquid options, and the CBOE publishes an index on that using the same VIX style methodology that we're familiar with from the VIX index. It's applied to those EWZ options, and the ticker for that index is VXEWZ, and so that's quoted on most software platforms, and it gives you that same 1 month model free type snapshot. I think that's definitely something worth looking at.
I was going to recommend that one as well, but I wasn't sure if you had some strange esoteric name in your portfolio over there that you wanted to throw out.
Well, yeah, I mean, there's some other indexes on the Bovespa, and there's like options on individual equities you can look at, but I don't find those to be of necessarily more value than something as liquid as EWZ.
At the end of the day, liquidity begets some great markets and also probably better estimates of what's actually going on in the marketplace from a volatility perspective. And certainly for our listeners, the lion's share of them, they can access this product much more easily than some of the other more esoteric things out there. All right, that's going to do it for our volatility review segment. And now, because we love to hear from you guys, we're going to open up the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, and welcome to the volatility voicemail section. This is indeed the portion of the show where you guys get your opportunity to join us here on the old show. Make your questions, your comments, your thoughts known to us as well as to your fellow listeners. And since we touched on this a little bit already, I think we'll dive into this question first here, coming in from a listener named Silas. And he writes, "Congrats to the Vol crew on such an excellent program." Well, thank you, Silas. He goes on to write, "I enjoy all of your analysis, particularly the addition of volatility breakdowns in other asset classes, including crude oil. I'm starting to dabble more in these asset classes myself, but I'm somewhat dismayed at the overall lack of tools for analyzing these products. What software do you typically use when breaking down volatility in products like crude oil? Thank you again for this fine program." Well, Andrew, this goes back to what we were just talking about. There is a bit of a dearth, shall we say, to be charitable, of quality products. You know, when for doing this type of analysis, when we're breaking down unusual activity or talking vol on things like the SPX or whatever, or Apple, there are a myriad of products and platforms to choose from. And in fact, most brokerage houses will make those tools readily available to you pretty much for free if you have an account with them. So the average, even retail client out there has access to a wide array of excellent equity and equity index and volatility analysis type tools on the equity side. But once you start getting on the other side of the fence, the quality just falls off a cliff. And there really are very few brokerage houses that offer any real good tools. Some of them offer some decent research, but the number of ones that actually offer decent tools is very few. There's also a problem when it comes to the symbology on the future side. It really is almost impenetrable unless you've been in the pits for all of your life. So it makes it hard to, even on some platforms that are very good, to see what the hell you're looking at because it's all quoted in the symbols as opposed to what it actually is. Instead of saying the VIX WTI, it'll say, you know, the ticker symbol. Unless you're versed in all the tickers, it can be very confusing. So there's a lot of issues on that side of the fence. That said, the one I've been turning to frequently, we talked about this the other day on the option block as well. We do some shows on the network that deal with this, including the longer and shorter futures options and the futures options roundtable. Whenever I do those programs, I tend to break out a software called Quick Strike. That's QUIKSTRIKE. You can search for that online. There's also, I believe, a free trial available on the CME Group website. And that's pretty much one of the better tools that I found for doing some of this analysis on the futures option side of the fence. They have pretty much all the different products you can look at. So if you want to look at rates, you want to look at ags, you want to look at the energies or the metals, it's all in there. They break it down by a variety of different things. They've added things like open interest changes, searches now, so you can search by different parameters of how much open interest changed. So if you're looking for unusual activity, that's a good thing for you. And they also do some fun little things like you can pull up straddle runs for different products, which as an old school floor guy, I certainly appreciate. So there's a lot of interesting things like that, and I've started to use that more and more just because there aren't a lot of other good tools out there. So they really, in fact, I like their slogan on this product. They pretty much say all the stuff you can't find in one place. And that's pretty much kind of true because there really aren't a lot of other places to go to find this data. And if you do, it's really, you have to look here for energies, you have to look here for the metals, you have to look here for the rates. This one at least attempts to approximate all of that in one place. That said, Jared, I'm sure you probably have some interesting sources you go to for information on the future side of the fence. Where's your go-to source for that type of information?
There's a couple tools I would mention in addition to the ones you said. Quick Strike is nice, and off the top of my head, I can think of, on the brokerage side of things, or in terms of more detailed platforms. Interactive Brokers has at least good quotes for what the products that there are, and some tools to analyze futures options. Bloomberg has good data, certainly. A little bit more economical scale of things. Volatility has some data if you're into downloading and analyzing data on your own. And I think they also have a graphing application. I forget the name of it, but I remember it being fairly affordable. There's also a report and an online tool. If you go to optionworks.com, I've spoken with the founder there a couple times, and they have some really interesting work that focuses specifically on futures options that people might enjoy. That's OptionWorks, and I'm not compensated, but I've used them in the past and found it really helpful. So, across, given that set of things we mentioned, I think there's, from the data end to the software end of things, definitely more opportunities to analyze these markets now than there were, say, 5 years ago.
That's a good one, OptionWorks. I haven't really played around with them. I'll have to give them a try. Mr. Andrew, I won't even bother tossing it to you because you've already said you pretty much just eschew all futures options tools because you don't like them.
I just say no
Yes.
on future options.
Well said, sir. All right, hope that answers your question, Mr. Silas. But you're not alone, so take heart in that. A lot of people are struggling with the same issue you are. Hopefully some of these tools you recommended can help you. Some of them more on the real-time type of, web-based UI, some of them more the download, the large volume of data, and then crunch it yourself in Excel. So whatever floats your boat, whatever side of the fence you're on, there's something out there for you to play with. All right, next up we have a question from George Dietrich out of near your former stomping grounds there, Jared, out of sunny Baltimore, Maryland. And he writes, are commodities better candidates for hedging strategies such as long puts or spec strategies such as strangles because they typically lack the high implied volatility levels in lower strikes? Interesting question, George. We get a lot of variations on this theme on the network. I think because a lot of people are coming to the commodities having first dabbled in the equity option products. And so they're used to investment skew, listeners, which of course is, the implied volatility. And the put wing catches a bid versus the calls that get a bit of a discount because people are long the underlying. So they're hedging and they're selling calls, and that tends to develop this sort of implied volatility skew in the marketplace. And people get used to that. And then when they migrate to other products like commodities, they start to get a little bit overwhelmed or freaked out or just surprised by the way volatility performs in those products. And George, you're right. Some of those products, you're right. Some of the products, the volatility does decrease on the way down because the fear is to the upside. Other ones are more of that, traditional smile where they kind of spike both ways away from the at the money. So it really depends on what product you're trading, which one is better candidates for that. But if you do have a product like that and you're concerned about the downside and the market isn't pricing that implied vol bid in there, then yes, if you buy some puts out there, it will be cheaper. And that's a nice thing. It's probably a refreshing thing if you've been paying up for something like SPY puts all your life and you go out to a commodity product and you don't have to pay that premium. It's probably a nice, refreshing thing. Mr. Andrew, you couldn't really comment on the tool, so I'll give you a chance to pontificate here. What do you have to say to our friend, Mr. Dietrich?
That is an excellent question, and I'm totally drawing a blank at this point right now.
I think I've just worn you out with radio, haven't I? I pushed you to your limit. You can't handle anymore. I was just
looking at his question, I'm like, okay, I don't know why I'm just drawing a crazy blank on this subject. I guess my biggest problem with it is, this is stuff where as far as software goes and what we use, I'm not looking at I'm always looking at the ETFs and just standard equity options. So a lot of this, I don't have a window into this particular type of thing. I guess that's the short answer I have for that.
That's my job here, to bring you out of your comfort zone, Andrew. And I think we've done that successfully here multiple times on today's show. So ballyhoo for us, Jared. All right, Mr. Jared, what do you have to say here to our friend, Mr. Dietrich?
It's a good question and maybe an intuitive one. I can say that the data suggests that. So if his question was, are commodity options better for hedging strategies because of changes in the skew? I'd say that if you follow his question out with the data, they're actually worse. And what I mean by that is, in many products, you don't just have higher implied vols at out of the money strikes on one side. You have it in both sides. And if you're familiar with the term, the volatility smile, that suggests a curve where it's not just kind of a crooked shape in the implied vols, but you actually have higher implied vols in out of the money to the downside and the upside. And that's the case in crude oil. That's the case in a lot of products. You can see that in gold a lot of the time. Natural gas is one case where a lot of the times you'll see something that looks more like a traditional curve you might associate with equity options, where you have higher price puts out of the money, the calls are relatively flat. And so I think in that case, you get a more familiar curve. But again, with a lot of these commodities, you can have either a genuine smile, or in some cases, the calls are expensive and downside puts are cheap, in which case there's not even an edge there from a hedging perspective, since in terms of momentum and reactivity, that movement's all in the direction of the expensive options again.
Yeah, I would just add, now that my head is slightly reversed, is, a lot of the trading the curve on a lot of those products is what at least all the guys that I know that trade them, that's like a bigger part of the game. They're managing risk, but it's the curve on the products that they're really kind of interested in, more so than actually what the underlying is doing, because the movement of the shape, a less skew, more skew, or you have increasing, decreasing, whatever, or, what percentage of the max is, the current skew trading. So that makes it actually a lot harder. And I would agree with Jared, if you're using those products in general, the at the money stuff is always the cheapest, or almost always the cheapest for a lot of those products. So, which it's cheapest from a vol point of view, but it's also a little bit more expensive from a net premium point of view. So, and in that case, they really use options as insurance, and they make it not easy to use the, let's just call it the tail part of the products for hedging. That actually makes it pretty expensive.
All right, great question, Mr. Dietrich. Thanks to everybody who wrote in, but now we have to keep on rolling right on into our final segment. Yes, it's time, listeners, to dive into the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, listeners, welcome to the Crystal Ball. This is indeed the portion of the show where we prognosticate recklessly and perhaps even wildly. So if you're not comfortable with that, turn off the show now, because it's about to get crazy, listeners. And when you think of crazy, wild prognostication with reckless abandon, you think of no one better than Mr. Jared Woodard of BGC Partners. So, Jared, let's prognosticate recklessly and indeed wildly. Don't worry, none of your bosses are listening.
The 10-year, it's going to 7% by this time next year. No, I'm only kidding.
That would make for a hell of a show next week.
No, but okay. In that vein, the thing that everyone's been afraid of all year is going to come true. It's just a question of when. And I think that this fall, you've got the potential for a couple things to make for a real meaningful increase in realized volatility around the world. We've talked before about divergence in interest rates among major central banks. We've talked about, certainly to death, the Fed's exit from unconventional monetary policy and whether they're going to get the kind of wage and price data that would justify that kind of a move. And when you combine that with traders and investors and money managers coming back from summer break, looking at where they are this year and feeling like, maybe I'm underperforming, or maybe my numbers are kind of weak and I really need to make my year, that can drive people to take a little bit more risk and be a little bit more aggressive than they would have been 3 months ago or at the start of the year, let's say. And you mix all those things together, and I think that if you get some kind of a legitimate, real catalyst in the marketplace, whether it's rates related or not, I think there's more potential over the next 2 to 3 months for some really meaningful movement in the market than we've seen all year. Given option levels as low as they are in a lot of places, I think that there's some really attractive hedging opportunities. I was looking, for example, at the term structure of implied vol in a lot of different equity sectors and some of the top names over the past couple weeks. And some of those term structures, I can tell you, are at the steepest levels that they've been at any point over the last 3 years, which means if you want to put on a long volatility trade, I think there's some time spreads, term structure type trades that you can do at extremely affordable levels that are going to provide some downside protection, even if the move over the next quarter doesn't turn out to be that extreme. But with that said, I think there's some really good opportunities for long volatility plays with a 1 to 2 month, 3 months time horizon.
There we go. Well done, sir. Hopefully Don isn't listening. All this talk of buying premium in today's show is probably just blowing his mind if he is. Mr. Andrew, has your head cleared sufficiently to prognosticate wildly now in the realm of volatility, sir?
I have, and I have to say, I don't expect a whole lot happening in the realm of volatility over the next week. I think this whole thing in Ukraine has got the volatility market pretty much locked up. As much as I thought VIX and all these things are relevant, VIX is expensive, future premium is expensive. I have a feeling it's going to lock things up for another week, maybe two, and we're going to get kind of this sideways action, and we'll get more of a grind and realized vol until kind of the dam breaks and something moves. But at 12%, volatility is still, it's still overpriced, and the market's not moving a whole lot. In general, that's good for investors, but as far as from a vol point of view, we're really not getting the moves. We're really not getting the moves that the options are implying that they should, at least at this point right now.
All right, thank you for that, Mr. Andrew, and that's going to do it for the Crystal Ball segment. It's also going to do it for this episode of Volatility Views, listeners. So go forth and enjoy the long holiday weekend if you're here in the States, and if you're abroad, listen to some archived episode. There's some good stuff there. But before we go, listeners, let's check in with each of my cohorts here on the old Volatility Views panel, see what they have cooking that may interest you. Starting off with you, Mr. Woodard, you already have your big straddles into earnings study. You already have now, as of today, your big weekend effect study. So you're going to be very busy. But aside from those two major projects, what else are you working on over there at BGC Partners?
I'm working on something that's even more important than all of those.
No way. Impossible, sir.
Which is that, playing off of the, what I just mentioned, for all the tools that are out there, I think for a lot of investors, it's hard to find opportunities in a really efficient and clear way without digging through reams of data and spending hours looking at charts and stuff. And so one of the things I've been working on is some sector breakdowns that show top names in each equity sector, along with key volatility metrics, to make it really simple and straightforward to find where opportunities are, either for relative value volatility trades or just for outright positions based on current data. And I've been working on that for a little while. Those things are almost ready, and I think they're going to be great and useful. In addition to that, I got to plug some of the work that we've done on our desk. I think one of the ways the guys I work with and gals are really excellent is that they're really good at finding what's going on in the flow, keeping an eye on markets, and getting a sense for what's happening in real time. And that's something that I think is one of those, it's an art more than a science, and you have to have some experience and some of those kind of skills to be good at it. It's not my forte, but I think the people I work with are really good at it, as I've been watching over the last several months. And if we do get a change in the tone of the markets over the next quarter, I think that sensitivity towards flow and towards investor positioning is going to prove especially valuable. And so I have to mention that in my plugs for this week.
Good stuff, as always, Mr. Woodard. And Mr. Andrew, take us home. What's coming down the pike over there at the Pit?
Well, you'll never believe this is actually apt. The Pit is going to have a free webinar on volatility, I believe the 17th at 6:30 Eastern time, which will be talking about VIX and how it relates to, and how VIX actually essentially is related to volatility. That would be a primer for the next webinar, which will be about $49 on October 4th to actually understand how the volatility products work, relative to the VIX. So you can actually use them for what they're intended to do. So we think that's a good volatility primer for a lot of people who want to learn a little more. And in general, the classes, we almost guarantee that you will learn something that you have not learned before, and hopefully it will be useful to you. That's what we got going in the land of the Pit.
All right. Thank you for that, Mr. Andrew. And on behalf of Jared and Andrew, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show and for sending in such great questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/The Options Insider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.